Britain believed it had taken back control. 25 days after the vote, its crown jewel of tech moved to Tokyo, $32 billion. On the surface, a 43% premium. But during those 25 days, the pound had already fallen 13%. It looked like an expensive acquisition. Through the exchange rate, it was a discount purchase. This is the story of how that discount stamp was pressed, and who read it first. ARM Holdings, headquartered in Cambridge. It doesn't make chips. It has no factory. But most smartphones in the world run on ARM's design language. Apple, Samsung, Qualcomm, MediaTek. Different names, same foundation. ARM didn't sell chips. It collected tolls from the world's mobile industry. Revenue flowed in as royalties, from everywhere. A large portion denominated in dollars. Even when the pound shook, ARM's business structure didn't. ARM's technology didn't become obsolete overnight. Its customers didn't disappear. But a single ballot pressed a discount stamp onto this asset. To understand how that stamp was pressed, and who read it first, we need to go back to the night before. June 23, 2016. The night before the vote. London's trading floors were loose. Dealers ordered pizza, passed around beers. The market believed the polls. The pound had already priced in a Remain win, sitting above $1.50. Nobody thought the stamp was coming. 51.9%. Just past midnight, Sunderland returned its result. Leave, 61%. Not what the polls had predicted. Algorithmic trading systems withdrew their bids simultaneously. Liquidity evaporated. The mechanism by which prices are discovered began to collapse. 2:20 a.m. FTSE futures down more than 5%. Risk limit alarms sounded across trading floors. Dealers could no longer physically execute the sell orders pouring in. 3:23 a.m. Leave took the cumulative lead. Phones rang without pause. Every call, market sell. Every screen, red. What was supposed to be a quiet night had become total panic. 4:18 a.m. The pound hit a 31-year low. From the intraday high of $1.50 down to $1.33. More than 11% gone within hours. Among the largest single-day drops ever recorded for a major reserve currency. What had been a political story had instantly become a global price tag. The pound's collapse didn't stop at London's trading floors. Overnight travel costs for British households rose more than 15%. Petrol prices began to climb. People woke up that morning and realized every price tag had been rewritten while they slept. When London's regular market opened, the panic spread to equities. Barclays fell 30%. Lloyds Banking Group collapsed 28%. Here is why it was so lethal. UK banks had served all 27 EU countries from a single London office. Passporting rights. Brexit would strip that, forcing separate entities in each country. The foundation of their revenue model was shaking. In 24 hours, more than $2 trillion vanished from global market capitalization. Mark Carney stepped in front of cameras just before the market opened. He declared £250 billion in emergency liquidity. When banks begin refusing to lend to each other overnight, the entire financial system stops. The Bank of England's guarantee broke that chain of fear. The panic was contained. But the pound closed the day down 8%. The price tags had already been rewritten. Inside the UK stock market, something entirely different was happening. The FTSE 250 collapsed 14%. The index of mid-cap companies dependent on UK domestic demand. The FTSE 100 was different. 75 to 80% of its revenues came from overseas. As the pound fell, profits earned in dollars and euros translated into higher pound values on the books. Simply put, Brexit didn't break UK assets. It made them look cheaper to holders of foreign currency. The same crisis, whether it became a loss or an opportunity, depended entirely on which currency you held. Monday, June 27th. S&P and Fitch downgraded the UK's sovereign credit rating. S&P dropped it 2 full notches from the top. For the first time since 1978, Britain was removed from the list of top-rated sovereign borrowers. A single ballot had pressed its stamp onto the nation's credit price tag as well. The first buyer to read that price tag was in Tokyo, Masayoshi Son, chairman of SoftBank. He began moving the morning after the Brexit result. His target? ARM, the company that held the right to charge dollar tolls to the world's mobile industry. July 18, 2016, SoftBank made the announcement. 1,700 pence per share in cash, a 43% premium to the last traded price. Total deal value, £24.3 billion, approximately $32 billion. ARM's board unanimously recommended acceptance. 43% premium was a number difficult to refuse. But the real number in this deal wasn't 43%. Since the Brexit vote, the pound had already fallen 13%. Yen strength, pound weakness, crossing. The actual cost Sun paid was approximately 30% below the pre-Brexit rate. Shareholders saw a 43% premium. Sun saw a currency down 13%. The premium was real, but the discount stamp had already been pressed on the price tag beneath it. Brexit's language was, taking back control, but the market spoke differently. 25 days after the vote to take back control, ownership of the UK's key technology asset moved abroad. The UK government had to frame this as success, not failure. Sun promised to double UK employment within 5 years. Cambridge headquarters, staying. Jobs remained. The HQ remained. But the most important right, the right to charge dollar royalties across the global smartphone industry, moved to Tokyo. Some called it a drain of national wealth. The government called it something else. Proof that post-Brexit Britain remains investable. Same deal, different label. The deal was precisely engineered. SoftBank adopted the scheme of arrangement structure under UK company law. Combined shareholder vote and court approval allows compulsory acquisition of minority shares. From announcement to court approval, 6 weeks. September 5th, all ARM shares transferred to SoftBank. September 6th, ARM's name was removed from the London Stock Exchange. What Sun bought was not a company. It was the right to charge dollar royalties to the world's smartphone industry. And he was not alone. What happened to ARM didn't stop at technology assets. The same discount stamp was being pressed onto London buildings. One difference. ARM was traded on the stock market. London property was locked behind the doors of funds. After the vote, UK domestic capital began draining out like a tide. Redemption requests at property funds spiked. Open-ended funds had promised daily liquidity, but the underlying assets were office buildings, months to years to sell. This structural mismatch is invisible in normal times. Incoming money covers outgoing redemptions, but after Brexit, incoming money stopped. July 4th. Standard Life suspended its £2.9 billion fund. The next day, M&G halted £4.4 billion. Same day, Aviva froze £1.8 billion. 2 days, 3 locked. July 6th. Henderson and Columbia Threadneedle shut as well. Within 1 week, more than £18 billion was frozen. Investors who had requested redemptions found the doors already locked. For UK investors, Brexit was a redemption request. For foreign capital, Brexit was a buying signal. Buyers holding dollars, yen, petrodollars moved into that vacuum. For them, Brexit was political noise. London's Mayfair scarcity was untouched. Only the entry price had changed. That was enough. The Qatar Investment Authority and Abu Dhabi Investment Authority moved into the heart of London, their currencies pegged to the dollar. Savills data confirms it. London office costs fell 0.5% measured in pounds. In dollars, 19%. Same building, same rent. A completely different price tag depending on which currency you use to pay. This difference decided whose hand pressed the stamp. Qatar Investment Authority secured ownership of London's finest hotels. Abu Dhabi Investment Authority acquired the Lanesborough. Qatari Diar announced a £2 billion rental housing project, more than 4,000 units. London's chronic housing shortage was untouched by Brexit. Enter now at lower prices. Build a long-term cash pipeline. The calculus of permanent capital. Hong Kong and mainland Chinese capital absorbed core city offices. Foreign investor share in transactions above £1 billion exceeded 65%. British domestic capital had exited. Dollar, yen, petrodollar filled the space. New names were being written onto discounted assets. Another figure had been watching all of this from London. Crispin Odey, hedge fund manager. He had been betting against the pound before the Brexit vote, June 24, 2016. As the pound collapsed, his bet hit precisely. His main fund recorded roughly £220 million in profit in a single day. First half 2016 return, 49.1%. The market called him a genius. But he missed one thing. When the pound falls, UK large-cap companies earning revenues in dollars see their pound-translated book values rise. He maintained short positions in UK equities. He believed UK stocks would crash 80%. The market moved in the opposite direction. UK equities rose 19.1% by year-end 2016. Full year 2016 return, minus 49.5%. Twice what he had earned in the first half, erased in the second. 2017 added another minus 21.7%. He got the event right, but he got the structure wrong. Predicting whether an event occurs and predicting how each asset class responds to it are entirely different problems. Keynes warned us, markets can remain irrational longer than you can remain solvent. Reading the structure and reading the direction are separate skills. After ARM's name left the London Stock Exchange, the UK government recorded the transaction as a success, but the right to own the brain of the global smartphone industry, the dollar royalty claim, had moved to Tokyo. The receipt had crossed the Pacific. UK fintech and AI startups moved in the same direction. Second half of 2016. US PE and VC acquisitions of UK tech companies rose 22% year over year. Converted prices, 11% lower. London's core offices were re-registered under new names: Qatar, Abu Dhabi, Hong Kong, Beijing. Capital that entered as British domestic funds locked their windows. The stamp didn't fade. Only who held the receipt had changed. Exchange rate is not merely a change in numbers. It is the structure that determines who can press a discount stamp onto which asset. Political events sometimes rewrite that structure overnight. Brexit didn't destroy arms technology, didn't destroy London's position. It only changed the price tag on the currency of entry. There is a law worth keeping from this story. Crisis does not change the nature of assets. It only changes the currency price tag attached to those assets. Depending on which currency you hold, the same crisis divides the hand that presses the stamp from the receipt that gets stamped. Brexit is not only Britain's story. The structure, where political events move exchange rates and exchange rates shift ownership, is still operating somewhere today. That stamp is still being pressed on some price tag, somewhere. The final question is this: is the asset I hold truly mine? Or does it only look like mine while the currency I use continues to hold? If politics shakes one day, and the currency falls 10% overnight, the asset may not disappear, but the price tag gets rewritten. And the person who reads that price tag first will press a discount stamp onto what I own. Am I the one pressing the stamp, or am I the receipt?